Welcome everyone to tonight's Hookup with Real Estate Masterclass. We have a super special guest, Candice Stearns, which we're very excited about, and we will introduce her in just a minute. Ken, would you mind reading the disclaimer?
Yes, we appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, tax, or investment advice. Nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hook Up with Real Estate and its representatives are not liable for any outcomes resulting from information provided or engagements with third party providers. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you. All right. Our mission is to empower aspiring and early real estate investors with exceptional education, invaluable skills, and genuine opportunities to invest in real estate while simultaneously sharing strategies guiding you toward success and away from costly beginner mistakes. And those costly beginner mistakes that we made are outlined in this book, Real Women in Real Estate, and I'm excited to share that our special guest, Candice Stearns, is also an author in volume 1 with me, so you'll get 2 wonderful stories and more for the price of one. Smith is a New Jersey licensed realtor. He is also a tile contractor and a veteran and a real estate investor. So if you're in the northern New Jersey area or need help with a referral, kenneth-hook.weichert.com. All right, this is one of our properties. We are powered by Legends Equity Group, and we got started in real estate multifamily through them. And we're also part of another team that is focused on industrial flex. This is let me go back. This is a 506C property that's closing soon. It's only for accredited investors, so if you have any questions, please reach out. There are 2 ways to connect with us. We have a YouTube channel, @Hookup with Real Estate, all one word. You can subscribe, like, comment. This video will be on that channel in about a week's time. We also have a Facebook groups with an S page /@Hookup with Real Estate where you can join and stay current with all that we do. We are able to answer any of your questions. If you'd like to book a strategy call, we give real guidance, real strategies, and real opportunities to invest. And this is our calendar. We are here in May. We do a monthly master class, as many of you recall. So May 27th is next. The next one is June 24th, and you'll receive more detail. The only exceptions are the ones in red, which are on the 3rd Wednesday. Ken, would you mind reading the quote of the day?
Yes, success occurs when opportunity meets preparation. Zig Ziglar.
Thank you. And now we get to the good stuff. We get to introduce our guest speaker. Candice Stearns is a formidable entrepreneur, businesswoman, a real estate professional. She's also the 4th-generation farmer where she learned the value of hard work. During college, Candice worked for a health insurance company, and there she saw the power of earning passive income via insurance sales. 2 years later, she launched her own insurance business, stepping into greater possibilities for passive income. As healthcare reform was taking shape in 2008, Candice saw policy changes affecting small businesses and seniors. This was a catalyst for her becoming politically active, lobbying on Capitol Hill for systemic healthcare improvements. Candice has since left the political arena. Now she owns two businesses, Stay Balanced Travel and Stearns HR and Compliance Consulting, where she is CEO. With her continued penchant for passive income, Candice found her way into real estate in 2021. She became a general partner the following year and never looked back. Her explosive growth is incredibly impressive, growing her real estate portfolio to $169 million of assets under management. Her portfolio includes 1,166 multifamily units across Texas, Georgia, North Carolina, Colorado, and Georgia, 70,600 square feet of retail development, 152 acres of land and farmland in Michigan. And Candice is partnered with the real estate investment group Massive Capital, where she functions as a general partner and investor relations. And again, I'd be amiss if I didn't mention that Candice is also an author, not just of the book Real Women in Real Estate, but she wrote another book, which she can share. And her vision is to empower C-suite executives and entrepreneurs with valuable, actionable content that frees up their time and enables them to pursue their passions through the creation of sustainable additional income. Now, please help me welcome Candice Stearns as she shares her views on private equity fund-to-fund investing with real estate, plus adjacent investing for high net worth investors and single family offices. I'll stop sharing. And where did Candice go? Candice, here you are. Okay, welcome, Candice. We always
Thank
like
you
to
so
start
much.
Welcome.
with the
Yes.
first question of how you got started in real estate, and then you can go from there.
Yeah. So I actually landed in real estate looking at a deal with the Cardone Capital people. I was one of his first people who invested in Fund One back in, 2021. And I got to meet Grant and Elena Cardone and went to one of their real estate events and quickly wanted to learn everything I could from a billionaire who obviously was making it happen in real estate, being an entrepreneur myself. And so I joined his club, met some other movers and shakers in the real estate business, and that's how I became a partner with Massive Capital Partners, LLC, that was formed in early 2021, and then started running like a gazelle in the business with people who had more experience with, you know, writing deals and learning all of the intricacies of inside and out of the deals. I had all the financial background, being in the insurance and financial world for almost 30 years. So I knew equity and funds and debt and the banking side, so to speak, and the stocks and bond side. But real estate is very local, right? So I mentored with them. And since I still have my partnerships and my GP positions with the Massive Capital folks, but I have since moved on and started my own capital compliance strategist firm working in the family office space. And so I appreciate the warm welcome from both Ken and Donna. And today we were going to talk about the private fund to fund and how family offices invest in real estate. And for any of you investors who have been acquiring assets over the years, I'm going to talk to you about what a family office is and why they're the up and coming movers and shakers of, $6.5 trillion.
Wow.
And so that's what Ken and Donna asked me to talk about today.
Well, thank you for that. We are also invested in Cardone Capital. I was at his summit in 2021 and 2022 in December, so I'm not sure if you were there, but yes, it's very
We
interesting.
probably were in the sea of people and just didn't connect. I know we connected through our authorship when we wrote the book together, and it's been great just, meeting such wonderful women over the years because women have become quite the powerhouse in real estate. So it's exciting. So yeah, so as Donna had mentioned, I'm based here in Metro Detroit. I've, spent 20 plus, almost 30 years now, working with business owners and high net worth families. And one of the, major questions that they always ask when we start working together is, I've built real wealth through real estate and all these different asset classes. How do I preserve it and pass it down to my legacy? And so that's the question that I'm going to help answer today. And we're going to walk through some, real world family office situations. We're not going to just throw out jargon terms, and it's not Wall Street speak because I'm Midwest, straight from the hip kind of girl. So let's just move right in here.
Sounds good. And if anyone has questions along the way, please put them in chat. There'll be an actual Q&A session toward the end.
Yeah, and I have a couple of, points in the presentation where I'll pose some questions too if anybody wants to chime in. So I like to keep it interactive so people aren't sleeping. I'm not a teacher. So anyways, as I mentioned, you know, I've I've been doing consulting work with high net worth families, and family offices typically start putting together a single family office around 250 to 500 million in assets and liquidity. I've raised and structured over about $100 million in the private credit real estate space with a couple of my family offices that I've worked with in a chief investor officer type role, which they give the beautiful acronym CIO. That's what a CIO is. It's a chief investment officer. And of course, Donna gave some of the other background information about me. So let's just start at the beginning and make sure that we're all on the same page with the lovely acronyms and jargon terms that we use in our industry. HNW stands for high net worth. That's typically a person who has $1 million to 30 million in investable assets, and it's not counting your primary home. A lot of people also will call these individuals accredited investors. The ultra high net worth folks usually have around 30 million in investable assets, and this is where the family office jargon starts getting bantered around. Those of you that are in real estate and are limited partners or accredited investors are familiar with the acronym AUM, which is for assets under management. And then the family office itself, a lot of people are not familiar with the term family office, but it's basically a private company of a team of people that are set up specifically to manage one's family money. So the taxes, the investments, the legal, the legacy planning. An individual or a business owner will actually hire a separate team of people that they then call a family office. You might have heard of, some family offices that will use the word estates. So it'll be Smith Estates or something like that is what it'll be called. Um, but that's in plain definition terms what a family office is. If you hear the word single family office, you're probably talking about a legacy, a generational office of family that maybe is third or fourth generation. They typically have a dedicated team that they are going to be paying $1 million to $3 million annually to like run their finances and their legacy and they probably have a foundation and things like that. And then there's another term called multifamily office. And multifamily offices are where there's multiple high net worth investors or business owners who typically don't have, 500 million in liquid, but maybe they have 12 million or 15 million, and they will join another family and share resources. So they'll have one family office, but there'll be multiple families that are under the umbrella of the family office staffing structure. And then there's investment policy statements. Those are part of the governance of a family office. And then, of course, the term GP and LP, which if you've done any investing in real estate with like Ken and Donna's projects, you're familiar with the term GP and LP because the general partner is typically the syndicate or the person who sponsors the deal. And then the limited partner is the person who basically is the passive investor putting money into that deal. And a family office will enter deals and work with funds on both sides of the fence. Sometimes they're the GP, sometimes they're the LP, sometimes they're both. So it just depends on whatever the business structure or the asset class is.
This is great. Thank you.
Yeah. So now, again, we're just going to briefly talk to you about what exactly the components of a family office are. There's, the investments. Oh, let me get rid of this little box. There's tax and legal, so that's where your CPA and estate planning and trust people sit. Then you have a family governance stack on the leadership team, which is the basic governance on how the family is going to operate. And in there, they make decisions about conflicts and how the money is going to be passed down and all that fun stuff. Then you have a reporting arm, and then you have a risk management arm, and then you have the legacy planning arm. And so that's where next generational stewardship and foundations get typically created.
So are you mostly on the investment side?
So I really act more like an air traffic control tower person for my families that I currently consult and work with. Because most of the consulting work that I do was with actually a virtual outsourced family office, and we'll talk about that in a couple of slides. But we're going to do a general overview right now of, again, the type of family offices there are. I have one single family office that's a seventh generational family office, so old money. And I do lifestyles planning and that kind of stuff for them. A single family office is, like, as I mentioned, typically if you don't have at least 500 million liquid, you're not going to want to be spending $1 million to $3 million annually to run your office and have a big staff. So again, that's why there's this other subset of family offices called multifamily office, where high net worth individuals that have 10 million up to 500 million will co-invest and share their resources with other high net worth investors for a family office. And then there's a smaller subset, which, you know, you and I can basically do. And this is how I started my consulting business is I set up my own virtual family office for myself. um, and what a virtual family office is they coordinate with fractional people and put a board of directors together and treat their own individual net worth like a family office with all the same governance and all of the same structure, just without, you know, the annual cost with overhead, bloat, and staff. Okay. And so that's what the three different types of family offices are. And that's the majority of the consulting work that I do now with high net worth and ultra high net worth investors. So you could really start a family office. Mine is called Stearns Estate. Shocker, my last name is Stearns. Not very original. But that's how I do a lot of consulting now with high net worth individuals that I've done deals with or joint venture partners with.
Yeah. Oh, fine.
And so, as I mentioned, family offices are exploding in growth. It used to be where syndicates and private equity would look to Wall Street and institutional investors. But now the numbers land where family offices have grown from 7,300 globally in 2019 to over 10,700 today, and almost 50% increase in the 6 years. And it's because there's been a massive wealth transfer that's been underway. The baby boomer business owners and real estate investors are selling and then suddenly sitting on more money than their banks know how to handle, quite frankly. So they've had this need to structure wealth preservation. It's not just about making money anymore. It's about how do I preserve the wealth and pass it on to my legacy. So again, there's $6.5 trillion being managed by families, and it's that amount happens to be bigger than the entire GDP of Japan. So family offices are becoming mainstream and overtaking, in some instances, some of the institutional level wealth management that's been going on in the past.
Hmm.
So, how do family offices actually invest? And this is why I was excited when Donna reached out to me, because when I was growing my syndicate with the Massive Capital Partners team, we were always looking for what they call anchor investors. You know, we'd have a project with the need of 32 or $35 million to buy a 400 unit apartment, and you can raise money $100 to $200,000 at a time, but it's sure a heck of a lot easier to work in an investment of that size with an anchor investor, with an institutional investor or a fund to come in and anchor half of the 35 million that you need to buy the property, as an example. So family offices are really an asset for general partners and syndicates who are looking for you know, not having a heavy lift on spending a year and a half or 2 years to raise capital. And 22% of an average family office's portfolio is actually invested in real estate for all the reasons that we love real estate, you know, the tax, you know, benefits and the appreciation and the depreciation and all of the rest of the things that we love real estate for. But family offices also will buy and sell businesses or do short-term loans into businesses that they've got a lot of experience in. So you'll see here in this pie chart that although 22% of a family office's investment portfolio is typically in real estate, they'll also have some in public equities like everybody else. And private credit is really big for family offices. And today we're going to really dump into the fund to funds and the private credit world. So you kind of like learn a little bit more about what private credit is. And those of you who have liquidity and money, you can see how to become your own bank. And that's really what a private credit fund is an individual who loans out their money like a bank would. So private credit in the real estate, and what is private credit and what family offices actually do as a private credit lender. So private credit is simply a non-bank lending fund where instead of going to your Wells Fargo for a construction loan, a real estate developer goes to a private fund or a family office, and the family office gets a higher yield. Typically, that yield is 8 to 14%, and they secure the loan obviously with the real estate itself. And so the developer gets speed and flexibility that a bank can't typically offer. And then when it's structured correctly, both sides win. So you'll have different types of private credit. The fund might act as a preferred equity. It might be a mezzanine debt. It might be a senior real estate debt. It could be a REIT, public corporate bonds, 10-year treasuries. These are all different yield comparisons. And what the private credit market does is they either will act as a fund or they'll come in as a fund of one of these other types of capital stacks. So we'll talk a little bit about the capital stacks and what these different debt instruments do. But why the family office loves the private credit fund is because it's very predictable. It gives a higher yield than a public bond, and it doesn't correlate at all with the stock market. Okay, so every real estate deal has a capital stack, and there's layers of money in each of these, layers, and each have a different risk level and a different return expectation. So we're going to start at the bottom because this senior debt or first lien bridge loan has the lowest risk. And this is where if you're working with a family office and a fund manager, the first time you work with a particular office, they probably will come in as a senior debt instrument for you. And the reason why they do that is because they don't know you very well. And this is the lowest risk. And although it doesn't provide GP 20% internal rates of return, it's the safer play and it's the first position. So it's at the bottom, it's the senior debt, it's the safest position, and it's first to get paid back, and it's the lowest risk. And it usually will eke out between 7 and 12%. And a family office that's trying to preserve $50 million, let's say, over the course of the next 5 to 10 years, will put their $50 million into a, secured senior debt like this and make 12% all day and be happy because it's better than a bond, right? And so above that is the mezzanine debt, and that's the higher yield. You might get 12 to 18%. There's more risk, and it's subordinate to the senior debt. Then there's preferred equity, which is your 10 to 14% dividend. It's not, it's a little different of an instrument. And then there's the pref equity and the common equity. And the GP is the one who typically has the common equity. It has the highest risk because they don't get paid until everybody else gets paid. And if it goes sideways, they lose it all. So, so this is the capital stack, and where um, the family office uses the stack is they'll do a single position strategy, as I said, mostly, as the senior debt. Um, and then some will do fund to fund strategies. And this is where it gets really fun for the family offices, because they actually will set up different funds where one fund will be senior debt, one will be mezzanine debt, one might be preferred equity where they're the pref check writer, and then another one they might just do the whole they might end up being the person who takes over the whole deal because they were the prefect and they come in and just buy the place out on pennies on the dollar because the operator doesn't do what they needed to do to get the deal done. So it's not uncommon to find a family office that plays in all of these instruments, but they do it through setting up a fund with a fund manager who basically is in charge of that particular part of the stack, and they're very seasoned and they have a lot of experience in that particular piece of the stack. And they know a bunch of people. They know operators, they know banks, they know, um, you know, they know their part of the stack very, very well. And by using these funds and these fund managers, um, they really are able to diversify their portfolio. So the family office gets diversification without having to underwrite each individual deal, because they have these managers, these chief investment officers, if you will, that are in charge of these different parts of the fund.
Interesting. We do have a two questions, well, kind of related.
Sure.
So Simon is asking, how likely is it for a family office to do a direct lending, or is it mostly through private credit funds?
So that is a depends question. It depends on how well the fund manager or the chief investment officer, and how well they know you. Um, Relationships with family offices are built over months and years, not weeks and days. And in order for a family office to come in and work with an operator, they need to see your track record and they need to see your cycles. So it's really important that if you have a project that you're working on and you're looking for family office or institutional money, that you have previous track records and operations to share with that family office and fund manager, so they can feel secure in investing in your project. Otherwise, they'll do more of a bridge loan kind of thing
Well,
versus being a senior debt person.
in my case, I place debt for a lot of folks,
Okay.
and I have like a lot of proven sponsors, lack of a better term, like specifically, for instance, I have a $90 million transaction where one of the partner is a billionaire, pretty well known.
Okay.
He sold his last business to Goldman Sachs for $3 billion.
Sure.
And one of the challenges I have is they didn't want a recourse loan. They're happy to put down $20 million or more out of their pocket.
Mm-hmm.
They're like, can you find us a non-recourse, right?
Mm-hmm. Yeah.
So for private credit, I think these will be, and not to mention what they're buying is pretty lucrative in terms of cash flow day one, and is killing it with the cash flow.
Mm-hmm.
So those are the type I think better suited for private credit market. And I'm starting to hear the chatters of like you said, a lot of funds are coming online lately.
Right.
That these are like popping up left and right. And I need to figure out strategic way to kind of like figure out who the heck these funds are and how to get to them.
Yeah, and so my recommendation to you is to connect with me on LinkedIn,
Sure.
and I can introduce you to some fund managers who
That
are
would be
in the
awesome.
private credit space. And if you've seen one fund, you've seen one fund.
Yeah.
What I can throw out there to the audience and anybody watching
Mm.
this afterwards on YouTube, um, get to know your private placement memorandums. Your operating agreements and PPMs, or private placement memorandum documents, are your best friend, and so is ChatGPT, by the way. AI can help you gather important information from 300-page legalese. So, just a little tip.
Thank you for that.
So, this is, um, you know, the fund to fund strategy through diversification. And this is just a sample of a family office private credit allocation. So, um, this chart is just a simplification example of how a $30 million private credit allocation might be structured across 4 different fund types. So allocations are going to obviously vary based on the family goals and the comfort levels in each of these capital stack strategies, risk tolerant levels, liquidity needs for the family office. And in this example, you can see $12 million is going to the senior bridge lending fund. Um, then you've got, you know, that's going to be producing anywhere between 8 to 10% yields. And there's 8 million that's going to go into a mezzanine fund, 7 million into a pref act position, and then 3 into an opportunistic fund with, higher yields and higher convictions. Inside those opportunistic credit funds, you could be funding oil. You could be funding, who knows, crypto. Every family has experience in business, and their opportunistic credit funds typically are their play areas where they do venture capital investing, right? Like your angel investors. Um, and why fund to funds again help preserve wealth is because you can see they're putting their main chunk of their liquidity and net worth in the safest senior bridge lending, where they can go, you know, take over the apartment per se if they go belly up on returning the money when they said they're supposed to return the money. um, and I have a lot of family offices that I've worked with that are general contractors and own a bunch of real estate all over the place because of exactly that. They defaulted on the loan and then they went in and took it over and turned it around, and now they're in multifamily. So let's head on over to how family offices have evolved over the years. Oh, wait, we're doing the two-side opportunity first. So whether you've got capital to deploy or you want capital for your fund, here's an action plan. So this will speak to one of Simon's, major questions. So these are some of the things that you have to think of when you're working with a family office. How do the family offices actually deploy their capital? The steps they go through. And then if you want capital from institutional investors or a family office, the other side is, here's what you need to think about or consider. So when you want capital for your fund, you've got to make sure you build a family office ready pitch deck. Okay. You've got to know your thesis, your deal sourcing, your strategies, your underwriting criteria. You have to have very, very clear investment, positioning statements and, one pagers with flow language. You really got to have institutional pitch decks. You can't go cheap on this stuff because they'll see it. They also will, what I call, undress you. And they really want to see all of your financials. You can't fudge anything. You've got to have a deal room, and you better have all the details in the deal room. And the details are going to include the good, the bad, the ugly. So make sure you're showing all of your track record and your cycles. Those kinds of things are really, really important. You're going to want to get a third party fund administrator. You can't go anywhere. If they don't see that you're not working with Apex or SS&C or NAV Consulting, eh, they're like, you're trying to bootstrap this thing. You're you're not serious. And so they kind of ferret people out this way. You've got to have established quarterly reporting. You've got to position things as an income for them, not a return. You have to remember family offices are all about preserving the dollars they have and growing interest from their money. Their money makes babies, as Grant Cardone always says. And so you want to position the language around the income that they're making, not just a return. They're not chasing 20 plus internal rates of return and stuff like that. They're just not. And the fifth is really the most important thing, a warm introduction. Family offices don't respond to cold emails. They work with trusted advisors, these teams, these consultants, their CPAs, their, you know, relationships that they've already built, over the course of 5 to 10 years. Now, if you have the capital to deploy, these are some of the things that you are doing when you're putting your investment thesis together as a family office or a high net worth individual with liquidity. You're defining your targets. Do you want to always have a certain amount of your wealth generating 10% or 8% or 12%? What are your yield targets? What's your risk positions? What are you comfortable with? You're going to be vetting fund managers and consultants like myself. And then you're going to start with 2 or 3 funds, and then you're going to diversify slowly over the course of 10 years, for example. And then you're going to have to build your reporting dashboards and your statements so that you're making sure you're treating your own family money like institutional money. So
So when you said that we would be vetting managers and consultants like yourself, what would be I mean, is it different than how you would vet a regular GP, or is there something else we should be considering?
yeah, I mean, it's similar to, if you think of it like you're going to create a board of directors, right? When you go to work with a CPA or a tax attorney or an SEC attorney, as a general partner, and you're putting together your first deal or you're putting together a deal, the same kind of vetting that you do with all of your, key people that are experts in certain areas. Those are the same kinds of things you're going to do with a consultant, a fund manager. That fund manager is also your chief investment officer, right? So you want to make sure that you're working with somebody who is very knowledgeable in what you feel comfortable investing. So, when you're setting up your first estate or your first family office for yourself, you're going to want to invest in things you're familiar with. You're not going to, if you're a real estate gal like I am, you're not going to all of a sudden go, oh, let's like dive into oil and gas, which I know nothing about. You know what I mean? So you're going to want to work with a fund manager or a chief investment officer person and bring somebody like that on your team that's in real estate that and probably you've worked with, maybe it's a partner that you've worked with in the past, um, and do it that way.
Thank you.
So how family offices evolved, I kind of touched a little bit on this, but before the 2000s, there was this passive era where family offices were mostly your long-standing generational wealth, that you've heard of, sixth, seventh generation people where they held stocks, bonds, very conservative, institutional, boring. The goal was don't lose grandpa's money. And then, there started to be this diversification area after the dot-com crash. Family office, expanded into the private equity and the hedge fund world in international markets. And then in 2015 and 2020, that's when family offices really started cutting out the middleman. They stopped working with the Wall Street bros and they started going directly to the operators, the GPs, and working direct and saying, hey, let's cut the bank out. Let's not worry about paying all these additional middlemen, a fee for this, a fee for that. In fact, let me just tell you, the first thing a family office doesn't want to do is pay any fees. They're like, can we just work this out with the handshake and our attorneys and call it a day? And then now the institutional area, they act like their own little bank. They're buying businesses, they're launching their own credit funds, they're co-investing with other family offices. The first thing I'll tell you is a family office loves to co-invest with another family office. They don't want a fund manager, an institutional manager that brings in all these accredited investors and a whole bunch of people on the GP table. It's me and you. Yay, let's roll. That's how they want it. And so they're either buying businesses that they're familiar with, they're buying real estate, that they're familiar with, they're creating credit funds, which are basically a bank lending institute, for lack of a better way of saying it. And that's the conversations that I'm having with my clients, both preparing to put together a family office or looking to get investments from a family office. So again, this is what a family office looks for in real estate. We touched a little bit on this. Whether they're an LP in your fund or buying directly, here's what they care about. They care about operational track record. Show me what you done. And they want to see how you performed when the real estate market went to hell in a handbasket in 2008, or when rates went up, or what happened in 2021, what's happening right now in 2025. They are very conservative underwriting. Like I said, they're not chasing 25% internal rates of return. They don't want to hear any of your dog and pony show. Liquidity terms matter. How are they going to get their money back? How long is it locked up for? How can they get it out? That kind of stuff. Capital stack clarity, fee transparency, all these matter. They hate fees for this, fees for that, fees for anything. And then governance and reporting. They want to make sure it aligns with their investment positioning statements and that they get the kind of auditing that they're accustomed to having on a monthly and quarterly basis. And then this is the problem nobody tells you about. Every advisor on your team is brilliant and they're inside their own lane and nobody is driving the whole car. And that's why it's good to have a person who acts as your air traffic control tower. The problem isn't the CPA or the attorney or the wealth manager. They're not bad for the generational wealth builder. It's just they're not optimizing the whole picture. They're just optimizing their advice based on their job, and nobody's looking at the whole deal together. So here's where I typically ask a couple of questions. Raise your hand if your CPA, attorney, or wealth advisor has ever been on the same phone call about the same deal. Have you ever had all three of them on? Good. That's good. That's good. Because often that's where there's a gap, is the CPA and the attorney and the wealth advisor aren't always on the same call and aren't always aware of everything that's going on. And this is where millions of dollars can quietly disappear. And that's, important that you keep that in mind.
Yeah, I'd say we had 2 out of the 3.
Okay, good. No, that's honest. So I put in a little case study of a business owner that I helped coordinate his sale of his company. He had a $500 million manufacturing company, 30 years, built from scratch, first generation business owner, bootstrapped it from nothing to 500 million. It was he and his brother, who had 25% equity, 2 minority partners, 10% each. They wanted a family office purchaser over private equity, because private equity is the kind of Wall Street game where they buy you and take you apart at your parts typically, and it's a roll up. The strategy is 5 to 7 years and then it turns and burns. And because he's first generation business owner, he loves his employees. His employees are his children, right? And he didn't want private equity to do that. So he asked me to help get his house in order, so to speak, so that he could sell the business to a family office. So I helped him structure all of the documents and financials with his tax attorney and CPA and estate planning person, so that it would be prepped for the right type of family office to come in and purchase it. And he wanted to maximize, obviously, the net proceeds, minimize his taxes, shocker, and then keep the team intact. He didn't want private equity coming in, firing everybody, and then, people need jobs. So this is how he wanted to preserve his legacy. CPAs like, let's do installment sale. Attorneys like, we need to clean up the shareholder agreement. Wealth advisors like, once the wire hits, we can diversify into this managed portfolio and blah, da, 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 da. And he just was like, Candice, how can I keep from paying $150 million in taxes? So this is how we structured the deal. One of the most important things was this IDG. So what does IDD stand for? It's an intentional defective guarantor trust. And I know the word defective sounds bad, but it's actually intentional and strategic. And here's what it means in plain English. It's a type of irrevocable trust where the assets are treated as outside your estate for estate tax purposes, but the grantor, meaning you, still pay income tax on the earnings. So the gap between how it's treated for income tax versus the estate tax is the entire strategy. And you are legally moving the future appreciation of your business out of your taxable estate before the sale triggers. And that appreciation, which can be tens of millions of dollars, grows outside of the reach of estate taxes. So this was the key to this particular deal, because the cash at close was 325 million. The rollover equity and the tax deferral was 100 million of the founder's proceeds rolled into this new holding company. That was the portion that deferred the capital gains, and the tax clock stopped at 100 million until a future exit event occurred. And then there was an installment note for the brother. The 25% brother received a structured seller's note, spreading his tax recognition over 7 years, smoothing out his bracket exposure. And then the minority partners got the clean cash exit. So both partners received 100% cash at the close. No rollover, no complexity, and each party kind of got what they wanted. But what was key is if we wouldn't have set up that IDG trust prior to the letter of intent happening, it never could have happened. He would have paid millions of dollars in taxes. So this is why you need like an outside person to sometimes come in and make sure all the players understand what's best for the business owner because they're just in their lane doing their thing.
So the letter of intent came from someone wanting to buy the business, not him.
Right, right. So the letter of intent came from the family office, right? But before we went and, found the player to sign an LOI, we worked with the CPA, the tax attorney, the wealth, manager, the advisor person, and we really had to figure out what the outcome was going to look like with the business owner. Because so often a business owner is approached by a private equity firm that's buying manufacturing, for example, or buying oil, for example, and they just throw a whole bunch of money at EBITDA, 7 times EBITDA, 15 times EBITDA, whatever. And the business owner's like, hell yeah, that sounds good. But until they take a step back and talk with like a strategist and say, hey, that does sound great, but what have you done to prep for to Uncle Sam?
Okay.
And they've never even invested in real estate before, for example. So I'm like, hey, have you heard about real estate? so so anyways, there's always different things that you need to be talking about with, high net worth individuals who are selling businesses, for example, and trying not to pay tons of money in taxes.
That's great. Simon has another question. Can you elaborate on how rollover equity defers taxes?
So you put it in a new company and you're actually just deferring the capital gains is what's happening. So you're putting it in a fund, basically.
Okay, so
So I I didn't know you could do that. I mean, so if you had just another company, you're putting it in, you can defer the taxes.
Yeah, so you have to set up a new holding company,
Uh-huh.
and then the proceeds roll into that new holding company, and then a portion of that deferred capital gains will stop the clock.
Okay.
Yeah, you have, okay, I am not a CPA and I am not a tax attorney. Let me say that out loud. You have to work with um, all the team and all the
Sure.
players, but if you have a circumstance that you want to run by me, feel free to set up an appointment and we can chat.
Yeah, I kind of like occasionally some of my clients are kind of in that spot. So, I would like to explain to a certain degree before I can kind of introduce, if I don't want to sound dumb. So, oh, talk to this lady. She's really
Yeah,
smart.
yeah. No, no,
Yeah.
absolutely. And again, I have I'm not a one-man operation, a
Yeah.
one-woman operation.
I mean,
I have a lot of experts that are a lot smarter than me. I just put them all in the room
yeah,
together.
I got planners and, I have private equity guys and, broker dealers. So I'm kind of familiar with a few different exit strategies from companies, including the whatever that structure was. You're selling it to your employees.
Oh, ESOPs.
ESOPs, yeah. So
Yeah.
I got guys that structure those ESOPs, and a friend of mine specifically that does basically sale and lease back after PE firm buys out a certain business and they divest real estate. They'll buy the real estate and then basically to lease it back to the private equity, and basically all they do is shake loose the money and take that money and go buy for next acquisitions. And
Right.
you know and he's in lawsuit with some private equity because they don't want to pay because business
Right.
didn't perform.
This is why I tell some of my business owner friends who are getting ready to sell, they're like, I just was offered X dollars by private equity firm so and so. And I'm like, hold on a minute.
Yeah, and in all cases, they would have just randomly closed up shop and leave and laid off everybody that worked there.
Right.
Crazy.
This is why the family office space is exploding because I can name off the top of my head 5 different family offices that are specifically in the manufacturing world, and all they do is buy tool and die and manufacturing businesses because, first gen doesn't have successor children that wanted anything to do with the business,
Mhm.
and they're like, now what do I do? And they love that company and they love those employees, and they don't want to see what happens often with all private equity firms that get sold out. So
Yeah,
Yep.
I could work with you in the future if something comes up like that.
sure, absolutely, absolutely reach out. So this is just where I ask, out to all who are participating in the presentation, should you consider a family office structure? Because, some of you are real estate investors, or you've had long-standing businesses, and I always just say these are the 7 trigger events that signal it's time to consider the family office structure. Maybe you don't need a single family office with all the staff, but if you sold a business or a major real estate asset, you own more than 3 properties or investment entities, your CPA, your attorney, your wealth advisors never met each other before. You're seeing funds and private deals offered that you can't properly evaluate. You've got adult children who are going to inherit significant wealth. You're planning a major refinance, recapitalization, or estate transition. You feel like you're managing a second job, just tracking your own investments. These are all signals that you should even look at potentially a virtual family office consulting firm to kind of help you structure something. And this is the smart family share model, that multifamily office structure where you've got family A, family B, family C. This is another opportunity for high net worth investors where you actually find multifamily offices. Like there's a couple in Texas that I work with that are solely real estate multifamily offices. They're all Texans who got high net assets, very similar to this structure, 15 million here, 22 million there, 18 million there. They share overhead costs. They have a full-time single family office cost that they split between 3 families. So it's more of a fractional cost, like people buying a fractional airplane. And it really gets them access to institutional deal flow. They've got high quality full-time fund manager with who's their chief investment officer that's doing all the research and you know everything they need on the SEC side. They're aligning values and goals. They're building generational relationships with other families that are in their space. And it's a really good model, and it's a really fast growing model. We're seeing tons and tons of high net worth individuals join these types of arrangements. And then this is just, again, partnering with a family office on your deal. For the GP and syndicators in the room, here's what they want to see before writing a check. You know, family offices love transparency, auditable track record, conservative-based projects, experienced teams, clean legal structures, consistent reporting, co-investing alignments. The bottom line is the family officer invests in the operator, not just the asset, and they build a relationship with you before you actually ask them for the money. I don't know if any of you have been part of any family office clubs. Richard Wilson has one. Fox, the Family Office Exchange, is another one. But if you are a limited partner and you've invested in multiple deals, you could and should think of becoming a member of one of these family office club investor groups, because that's how you can share a lot of deals and find a lot of deal sourcing too. And then of course the family offices hate all of these things. First time fund managers with no, cycle experience, and you don't have auditing or third party administrators, or you're rushing. We need to close in 10 days. I need your money. Not good signs. So, and then I always like to give a give back, a concrete actionable plan. So here's a 90-day family office action plan. You don't need to build a family office to start thinking like one. So in the next 90 days, you could, days 1 through 15, list all your assets, take a look at your business investments. Most people have never seen it all on one page. So putting together like a one-page family balance sheet is a good idea. Days 30 to 45, you can identify concentrations and risks. Where's too much of your money tied up in one deal, one operator, one property type. Days 61 through 75, create a decision rhythm, set up monthly 30-minute financial reviews. What got distributed, what capital calls are coming, what deals are in the pipeline. Days 16 through 30, define what you're protecting. Days 46 through 60, assemble your advisory team. Days 76 to 90, set your deal filters. So these are all ideas that you can take and put together. And then these are the 3 questions you can take home. What risks do I own that I haven't named? Who's responsible for saying no in my portfolio? And can the next generation understand what I built and why? So these are 3 questions that you can ask yourself and spend time with your spouse. And these are how the wealthiest families don't just chase returns, they build systems. And that makes some better decisions that are repeatable. So.
Yeah, this is great. So if a family office has, let's say, a first generation, and the subsequent generations aren't particularly interested in what they're invested in, what do you recommend to those folk?
Sure, you can. So first of all, you're going to want to start with your advisory team, your CPA, your wealth, advisor, whoever you're working with, and then a good estate planning trust attorney, because you can set up instruments in trust accounts, which are basically funds. They're like your own private fund, right? And you can set those instruments up so that you can put somebody in charge of investing in safe investments and structuring generational wealth that's going to kick out 8 to 12%. So after you're gone, if you know your heirs aren't interested in real estate, you've at least set up a trust that's perpetual and generational. And if they, decide to go into some other line of business and not do real estate, you can have that trust at least set up for investment purposes to continue on. Now, I would tell you eventually they're going to get into real estate whether they like it or not. But they may not be interested in it because they have other things they're pursuing at the moment. I have a 22-year-old and a 19-year-old, and neither of them are interested in real estate or anything boring that mom does. But that doesn't last forever. So
Yeah, our kids saw the worst of our times and they're like,
yeah,
so real estate. So, but hopefully they'll see the best of our times too. Mm.
sure.
So we have about 13 minutes. Who wants to come off? Simon, I know you have another question. Let's go.
Oh no, it's given me a whole lot of ideas. I'm one of those guys that got kicked in the teeth in the last 2 years.
Sure.
So, and survived. Talk to me this fall. I may have a tale to tell. I've been told that they haven't seen anybody survive that came through my position. I'm surviving. And anyway, the some of my future strategies, there are new things that I'm doing that's kind of lucrative, and I was, thinking that one of my exit potential would be in a private equity exit, but now I'm thinking, you know what? Maybe it might be good to do, it's a it's a cash flow deal, and I'm thinking it might be a good to pitch to a family office in the future.
Sure.
What do family offices think about people that have had, been beaten down by, let's say, the 2008 market or the current market cycle and then have come around? Are they, anybody who had a black X on their record, they won't work with?
So if you survive, you have stories to tell, then you're not going to have um you're going to have some street cred. Let me just say that. As an operator, okay? Um failure is your best learning experience. Right? Um and I think Grant Cardone is a perfect example of that. Like his story is how he went, completely to zero. Um, and what he learned from that and all of that. What I can tell you is um, every family office is different. Um, and they're just people like you and me who, acquired assets and wealth over a period of time and put together a system and was smart about it and said, how can I continue to preserve this wealth over generation 2 and generation 3? One of the sad things I can tell you about family offices is most family offices are completely, like, lose all of it by the third or fourth gen, because they don't put in proper governance. They don't put in systems. They don't do a lot of these things in the last two slides that I was talking about. Um, and they just think, the kids are going to figure it out. But they don't bring them in. They don't share the governance with them. They don't share the team and the strategies with them and bring them into the financials. They wait until it's too late and, they're gone before the kids really understand what's going on. And so that's part of that consulting or air traffic control tower piece that you need. Is you can have an expert in a lane of X, Y, or Z, but having somebody actually work with all of the family dynamics and actually manage the relationships of the family is, I think, just as important as your wealth manager or your chief investment officer. um, so you don't want to underestimate that role in your virtual family office or multifamily office or whatever.
Yeah, and in the virtual family office, I'm trying to remember what you said. What is the minimum they usually have? 5 million for the,
Yeah, usually 5 million in assets and liquidity of, 500,000 typically.
oh, okay. You want to go through this slide kind of quick about how you help? Wait, go back.
Oh, there we
I'm
go.
sorry, the slide you were on about how you help.
Yeah, there we go. Yeah. Yeah, so family office consulting is for serious investors, and you don't have to have a bloated office. You can build a family office and have an operating system around your goals. You can review your private market opportunities. I help with coordinating CPAs, wealth advisors, operators, so they work as a team. I prepare business owners for liquidity events like I showed you in that case study. um, Generational transitions I help with. If you don't have an investment policy statement, we can start there. How do you invest? What do you invest in? Like in my family, we have very clear cut investment goals. And so, um, I'll only do investing in real estate, but I also have ETFs and, other commodities. I'm a commodity girl. I like tangible stuff. I'm a farmer. My brother grows soybeans. So we're in that business too. So, but everybody has different things that they feel comfortable with and they invest in, and that's a huge start. Just putting that together. I don't invest in this. I do invest in that.
All right, cool. Do you have anything else you want to share?
Yeah. So like I said, that's pretty much how I help, and I'd be happy to speak with anybody if they want to reach out to me. I got my information there. I have my own website, so you can see the 3 businesses I work with and how to get a hold of me. So,
That's awesome. All right, let me just see. Is there anyone else on the call that has questions?
Well, I already reached out to Candice on LinkedIn.
oh, thank you.
Do you want to put your LinkedIn
That was
profile in the chat? So,
Yeah, let me see.
Yeah, we were already connected through some mutual people, so
Oh, good. Okay. Yeah, let me cut and paste it. Hold on a second.
Tom, do you have any questions?
yeah, and I can reach out if it's a, excuse me, if it's a better conversation somewhere else. But I was interested, you were talking about how a lot of family offices are taking the position of being the senior lender on these debt profiles for investments in real estate. And I was curious how how do you even go and approach to start building that relationship and start even showing them, hey, here's the partners I work with, here is my investment thesis, and kind of stuff like that.
So I would highly recommend, again, joining some of the family office organizations and clubs. Um, Fox Exchange, Richard Wilson's Family Office Club, Opal. Opal's another one. So you can engage with those organizations and those clubs either as an investor or as a GP or what they would call a sponsor. And so those are ways to get in the rooms, to have a seat at the table.
Okay. If I were to look on LinkedIn for family offices and stuff, is that where they'd be, or where would I
Yeah,
look
if you
for
want to
contact
actually,
Opal?
I put my LinkedIn there. If you want to reach out to me, I can just send me a direct message and I'll send you some links and
Okay.
connect you to some of the people so that you can get involved that way.
Perfect. Yeah. Thank you.
Yeah, no problem.
And Zeph, have any questions?
No, I don't. But thank you so much. It was great uh, talk you had. I'm sorry I'm not on the video. I was just driving
No
and I'm
worries.
but
Many a
thank you.
day I'm not on video.
Hey, Candice, I how do you feel about those family office conferences? I mean, the last one I went to, it was 90% of the room looking for money, and they were all swarming the guys with money, right?
Yeah.
And I'm
So which one did you go to?
one down in Miami.
Richard Wilson's.
It was this was a number of years ago.
Yeah.
I used to work for a fund in New York,
Sure.
and we went down there, and that's I'm assuming that's like very common theme. And one thing I know for sure, not knowing anything, is that you don't go to conference, you don't do pitches at conferences.
No.
You will never get noticed. This is just terrible thing, and everybody's like trying to do pitches at the location. I'm like, dude,
No,
that will
it's
not
not.
happen.
No, and Simon, you hit the nail on the head, so to speak.
Yeah,
I joined the Family Office Club, which is the Richard Wilson
yeah,
one. He has his summit, his one of his biggest investors meetings
yeah.
is the one in Fort Lauderdale. And it's always like December. It's right during the Art Basel
Mhm.
event that happens in Miami. It's always right after that. It's the few days right after that weekend. And I became a member of the club in 2021. And what I can tell you is when you become a member of the club, you need to sit in the room, listen to the billionaires that are on stage, and then actually get to know what they invest in and build relationships with their people that they bring with them. And then through that, that is how you begin working with the actual family members themselves. Um, you know, that's how it's done. And I joined, it was also the December one in 2021. Um, and I've been a member now, so this will be the fourth year. It wasn't until 2023 that I actually got a really good connection to one of the New York family offices that's always on the stage. And we did some consulting work, some joint venture work together on some properties where I was raising funds and they were interested in the exact market that I was in. It was storage facility. It was a storage facility unit. And this guy only does storage. So you have to know these people. I ran for political office, and so um, I had learned the skills, the soft skills of knowing how to ask for money, right? And part of that is knowing the person. You need to know everything about the person. And you need to make sure that what you're looking for money in is what they even invest in. Because if it's not something that's in their investment statement, then
Sure. I mean,
don't waste your time.
it was a kind of rude one. I went through 2 rounds of syndication. I'm the main sponsoring GP.
Hmm.
And like majority of the people that I marked as oh yeah, the short thing, they're coming in.
Yeah.
I mean before, because I know them, and then
Right.
they none of them came in.
Right. Yeah.
And some people I just totally did not expect. They're like, oh yeah, I got some money.
Yeah.
And it was just kind of and then I just started to study some of these psyches, and and then I mean later on I read the book, Pitch Anything with Oren Klaff, and all
Yeah.
this kind of things, right?
Yeah.
And so it's a work in progress still.
Yeah, and they're also not going to come in as your anchor on the
No,
first deal.
no.
I mean, they might have 20 or 30 million that's liquid that they can invest, but first time deals,
Yeah,
a lot of family offices, their first deal, part of their governance and part of their investment positioning is first deals always 1 to 2 million. I don't care if you're Trump.
no.
I don't care if you're Warren Buffett.
I did a strict, I guess, lack of a better term, joint venture with a high net worth individual back in 2011,
Mm-hmm.
and did exited the deal in 2014, and that was my cutting teeth, and I'm not knowing anything about how to structure deals, right?
Mm-hmm. Mm-hmm.
And they kind of took advantage of me a little bit, but
Mm-hmm.
I take that as a lesson.
Right.
I allowed it to happen. It's my job to know if I'm getting in business. I can't be naive and somebody took from me. That was a very good lesson for me.
Right. Right.
So Simon, we have to be respectful of Candice.
Yes, yes. I'm so sorry.
That's okay.
That's all right. I know. It's an interesting conversation. Um, First of all, thank you so much, Candice, for sharing your wisdom with us on family offices. This was a fantastic presentation. I know we
Good.
have,
I'm glad you guys enjoyed it, and I appreciate the opportunity to talk with your folks. So,
Thank you.
if anyone wants to get connected with Candice, she is on LinkedIn. She put her contact here, linkedin.com/in/Candice, Candies.
yep. It's IUS. You won't see it like that anywhere else.
She's been special.
That's right. I'm special.
All right. Well, I'm gonna pray this recording worked, and I thank you again. And I'll post this on our YouTube channel within about a week. And again, we so appreciate your time and
Thank you.
Thank you.
Thank you, guys. Have a good evening.
You too. Thank you.
Thank
Bye-bye.
you.
Bye-bye.